So let me go back and just review. Now that I got the recording on. So I got the solutions to the homeworks and the take home. You can use them today. You can come by and see me and I'll bring them to the class so that you can check your work. We'll go over the case study diagnostics, which is, do you have any specific questions? So I do have a question on WAC and just had some questions on the ratios, which I'll go through again. Any questions on the valuations? Are you comfortable with coming up with the discount rates? Really, if you can calculate the WAC and the CAPM and you have the expected return on the market, they're going to be fairly tight. So you just set up the sensitivities. So it's either going to be 7, 8, 9, which is probably the scenario you want to use. The WAC is probably going to be 7, so there you have validation. 8 is going to be the expected return on the market. There you got validation. And then your capital asset pricing model is probably going to be around 9. There you have the validation that validates your sensitivities for the discount rates. So that would be for perpetuity. We also know that we can't use 2 and 3% for Gordon growth, but we're still going to calculate them so that we have the Gordon growth, valuation grid, and make sure that you know that on the diagonal is going to be the same valuation. So that's the first thing I'm going to do, is to see if you corrected it right and see if the values are the same on the diagonal. Okay, and then you have to choose which one you're going to use. Do you use the WAC at 7? Do you use the expected market return at 8? Or do you use the CAPM at 9? A lot of students in the past have used the 9 and 1, which is basically 8, because they know if they use any higher growth rates, the valuations are going to be too high, and if they use too low of a discount rate, the valuations are going to be way outside the 20, 30% premium. So it's going to start to raise some red flags on the valuations. On the multiple approach, we already went through it. You can use perpetuity, Gordon growth. They were around, what, 12, 13. It's currently trading at 13, which is good. It was 13 last year for JP Morgan. If you look at the grid for the top 5 banks for 2015, 16, and 17, you can see that the lows are like 11, 12 for Citi. Citi's not really a direct competitor. Goldman was like 14. That company's over leveraged and is really more of an investment bank in a high quality, client services company, where JP Morgan, Wells Fargo, B of A are really banks. So those are probably the 2 of the best comps that you can use. And you'll see that their multiples are in between like 12 and 13. So through the analysis, through that competitive market analysis, you can see the ranges, not only historically, but across the other banks. And then you look at the most recent. So obviously 13 is probably the best scenario for the multiple. But again, you may have a different view. You may think that Trump can really push through and Congress could really push through, and by February 1st, they're probably back in Washington right now working together to dilute and rewrite Dodd-Frank right now, because they know it's going to be the easiest thing to push through by both sides of by both parties in both houses, and then go straight to the presidency. And they're already having the industry writing the regulation right now. So they got the industry groups on Wall Street rewriting the legislation right now. And you got Congress ready to go to sign that thing, and they're giving inputs right now, even before January 20th. So that's going to be one of the first things that they go after. Obamacare is going to be a little bit harder, but the tax cuts will be easier too. But they're going to probably have to rewrite a portion of the corporate tax code and the personal tax code. That'll take a little bit. But if there's any executive orders surrounding all this stuff, you can just sign it and then repeal it. If Obama did anything. So you have to ask yourself, what does it really look like? Further earnings growth rates for next year. Obviously the stock price is at 80, around 77 to 80. They're already factoring in very high earnings expectations, for next year. The question is, do you think the multiple is 14, 13, or 12? Probably not 12. Not as of today. It's probably between 13 and 14, and if you pick 14, you have to justify it. Okay? But you could probably get away with it. On the DCF, you got to pick the discount rate. I think we already showed in the last week that a 7 was too low. An 8 was probably reasonable, and a 9 would be conservative. Then your growth rates, I think we made some mistakes. I'd say half the classes, of the 4, did, I think, a pretty good job of forecasting the growth rates and the discounted cash flows over the 5-year holding period. I think a couple classes went really too high on the growth rates, which made the intrinsic values using discounted cash flow outside the 20% range and even into the 30-something range. And I think one of our classes had 50% or 100% premium over the current stock price. So you were using too high growth rates. With the holding period, you're using too low of a discount rate. And if you were using too low of a going-in discount rate, your terminal discount rate was probably too low too. So you have to, if you program it right in Excel, you can go back and recalibrate it. Recalibrate the growth rate scenarios and then bring up the discount rate pretty quickly. And then the scenarios, the scenario weightings, 5%, 5% perpetuity, Gordon growth, 10%, 10% is probably a better weighting. And then you got 30-50, that's probably the ideal. And then if you want to do 15-15 or 25-25 across all of them as your last scenario, now you got a range of valuations. But make sure you put the intrinsic value scenario in the middle, because that's the first place that I'm going to look to find the solution. And then make sure you have the buy recommendation underneath it. Above every table in the valuation, you have to make sure that you say intrinsic value, and it's going to be either greater than or less than, and then put the two prices together so I can go right there and check out the prices. I don't need to read the words on each side. It's more for formatting, but I'm going to go straight to the numbers. So there's always going to be somebody on the board or on the investment committee that's going to be a numbers person. It's really going to be checking the numbers and looking for reasonability. So the first thing I'll do is I'll look at the valuation compared to the current stock price, and I'll go right to the premium and see if you're over the 20%. If you are and it looks justifiable, it's okay. If you're under, that's okay. If it's the premium's like really low for some reason and it's almost the same as the stock price, I'll be asking you, why did you use a buy recommendation as opposed to a hold recommendation? If the premium is significantly higher than 33%, or if it gets into the 40, 50, 100 range, I know you use too low of a discount rate and too high of growth rates. Okay, so a lot of it is just reasonability. Do the numbers look reasonable? And that's why you need your teams to audit the numbers to check and make sure that they make sense. Okay, and if they don't look right, then they're not right. Okay, you gotta remember that you're only making a recommendation. Buy recommendation with the trades. I'm not looking for the highest valuation. I'm looking for directional. Right? Is it above the current stock price by a significant margin to make a buy recommendation? Is it close to the current stock price to make a hold recommendation? Or for some reason, I don't know why, that you think earnings expectations growth rates are going to drop significantly over the next year or next 5 years, and you think, discount rates, are going to increase significantly. That might be a scenario. The interest rates will continue to go up, and the 10-year Treasury will reach 3 or 4% by the end of next year. That would be a pretty big move, but it's not unlikely, considering all the fiscal policy that's going on and all the revisions in inflation expectations. So, but you can't go too high on. I wouldn't go to 5% on your 10-year. I probably wouldn't go to 4%, because that's maybe a 2018 scenario on the risk-free. So a 3% is probably likely. So you're factoring in a 100 basis points or 50 basis points increase in the 10-year Treasury, which could be done by the end of next year. There's probably going to be more stock market volatility in the market, so the betas probably are going to be higher than they are today for a lot of these firms. And then the expected return on the market's going to be, you pick it, 8, 9, or 10. I'll leave it up to you to decide.
Will you go over how to find your beta again?
Yeah. Well, usually what you're gonna do is you'll look it up,
Yeah,
you know, from the different sources, and you'll get kind of a range. We've been told, based on the inputs from you guys, that the beta was reported below 1, and it is a big firm, so that's probably probable. It's a really big firm, it's a couple trillion, so the beta should be around 1. The beta should not be higher than 1.5 because it's not an over-leveraged firm, and it's a really big firm. So the beta's gotta be somewhere between like 0.11 and, 1.11 and 1.13. I mean, I probably wouldn't go to 1.14, I wouldn't go to 1.15. So it's gotta be somewhere in there. And that's really, it's not gonna make that big of a difference on your results. What I'm looking for is, did you think through the process and then say, okay, we're looking at probably higher stock market volatility next year. JP Morgan stock is gonna be more volatile than the market. Therefore, the beta's gotta be greater than 1, but it's not over leveraged, and it's a really big firm. So it's probably gonna be less than 1.4, it's probably gonna be higher than 1.1, and we decided to get it on 1.3. So you explained it to me, how you came up with it, and that's gonna be okay. The board and the investment committee is gonna go, okay, we get it, good job, and then they'll move on, okay? But if you say, I don't know where I got it, we got it from the report you gave me, that's not an answer. Okay, there's no way to explain that away. And then you lose credibility right there in your research. So I'll start getting suspect about all the assumptions that you're using in the valuation. And you just don't want to go there. Okay, any other questions? So that kind of walked through it, so let's go through it. Does anybody have any other specific questions on the approach, particularly the assumptions? I talked about beta, I talked about risk-free rate. We talked about earnings per share growth rates. Not really worried about the first year projection for the perpetuity and the Gordon growth and the multiple, but I am concerned about your earnings per share growth rate projections over the holding period. That's gonna be the toughest. And again, if you're getting really high numbers, just take down the growth rates. We'll keep the slope of the growth rates. They should be going from high to low. Keep the slope, but just take them all down if you're getting really high numbers. Okay. And then I'll go over the WAC too. So the JP Morgan is the target firm. The direct competitor is going to be Wells Fargo. Peer group calculation we will do an example of that. The industry, again, like I was telling Joanne earlier, you want to try to get the financial ratios from one source so that it's the calculations are consistent. And then the industry reports I don't have really a problem with because I'm not really benchmarking the performance of the target firm really off the industries because that's just a blend of 2,000 companies, so they should be able to exceed the industry pretty easily. So you can get the industry from the S&P report, industry report, or the IBIS report for commercial banking. Actually, if you look at these reports, they're going to give you some industry SWOT analysis. They're going to give you an assessment of the overall industry so that when you're making the presentation, you can put the firm's performance in the context of the industry. But you're going to have to read through that industry section. And regulation's a big deal. And you'll read about it, how they talk about Dodd-Frank implications on the earnings. Those reports were written in September. So you'll have to modify your articulation of the overall industry, which the overall industry stock prices went up significantly over the last 7 days because everybody's anticipating some kind of rewrite of Dodd-Frank, which would be positive for the banks. Financial condition, position of the firm, I can go over that again. The scenario analysis, we already talked about it. Scenario 1, scenario 2, scenario 3, I'd probably do 0.15, 0.15, this one's 0.1, 0.1, 0.3, 0.5, and I would do 0.05 here, 0.05 here, and this is what? 40,
the scenario analysis,
Yeah.
you basically just pick the middle number between those as the, like, your number you're gonna use for like a buy or hold situation? Or
Yeah,
sell?
you just use the middle number.
Okay.
Unless, like in the board growth,
Mhm.
I've had a lot of students that say, you know, that growth rate, you know, into perpetuity adds a lot of, you know, a lot
Mhm.
to the calculation. So what I'm gonna do is I'm gonna use CAPM at 9% and the 1%. Because that way, if I use expected return on the market -1 or weighted average cost of capital -1, my valuations get into 30% premium range. And I wanna keep my valuations a little bit lower, and I wanna use a more conservative scenario.
Okay.
So I'm gonna use CAPM and 1.
Okay.
Okay, but you'll have to test it to see where your valuations come up. And it's all gonna be based on your first year projections, right? You know, what did you grow the earnings per share out from last year to this year? Is gonna have the biggest impact on where you end up, right?
Sorry, I just have to go to work.
Oh, okay, cool. Do you want a muffin before you go?
No, thanks.
Okay. So that's 30, 40, 50, 60, that's 0.3. And this is 30, 40, 50, 60, 40. So I would probably use those three scenarios. And then I'm giving it away, use that one. Just so it's consistent across all the presentations. So there's your scenarios. And you just gotta calculate, if you take the midpoint or if you pick the intrinsic value scenario across the 4 different scenarios, or the 4 different valuation methods, then it's just a weighted average calculation. It's very similar to the ratio, peer group ratio analysis. It's a sensitivity. I mean, it's a weighted average too. Okay. So is everybody clear on the scenario analysis? What scenarios you want to use? Right here. Okay. So that way I can alleviate some confusion. And then we know the trades, right? We know the trades, and we know it's going to be 4, 4, and 4. Let's just make it easy on us. So you got a grand total of 12. Okay, just make it easy, but show me the right trades, right? And then make sure you say, you know, buy JPM, buy JPM on margin, buy JPM calls, buy JPM, right JPM puts. You know, buy financial services, ETFs, buy financial services, ETFs on margin, buy financial services calls, ETF calls, buy financial service ETF, right? Financial service ETF puts. And then buy forwards on financial services, stock price indices, buy futures on the same, buy calls on the same, buy puts on the same. And then you have the list of the trades. And then don't forget, that after that last summary recommendations slide, you should have your references. I don't care about a question and answer slide. I like to see the references. And I would put the references up. I'd put all those up, just so that you have them available. So you're putting, you know, company website, you're putting Value Line, Merchant, S&P, IBIZ, blah, blah, you know, put all the Morningstar, put all those on there, okay? So I know that either you used them or you didn't use them. I really don't care, that you know where to go to get the data in the future when you're doing other research, potentially in other classes.
So we put the references on each slide at
No,
the bottom?
well, you can. I mean, that's really good to put, you know, right at the bottom, just in really small type, but just large enough, say reference. That just legitimizes your numbers.
Okay.
Because then I know you didn't go to Yahoo Finance, you know,
Yeah.
just hack the numbers out of there and slap them into the presentation because it's easy.
So-
It will legitimize and validate and verify that you got good information from reputable sources. So now you've co-branded with those providers and legitimized your research. And then restate those references at the back.
Okay, so you like a slide at the very end as well?
Yeah, with just references, yeah. If you, the best way to do is you put references at the bottom. It doesn't take up a lot of space to detract from the analysis. But it's like, oh, where'd you get the beta? Oh, I can see you got the beta from X, place where, I can see where you got your information. And that's really, really important. And then again, hit them again at the end of the presentation with the references so they know that you did the research and you used the best sources of data, not the worst sources of data. Okay, I think somebody else had some questions too. That's what we've got here. Anybody else have any other questions? Okay, so that's the traits. And then I did send you the first set of postings, which has the intrinsic valuation from the final on there. I'm uploading right now the second set of videos, and then I will upload this recording too up there so you have plenty of resources to refer to. Okay. So any other questions, specific questions on any problems that you may be currently having with your approach? Okay, let's go over the weighted average cost of capital calculation, because that was one of the questions. So, did you come up with the cost of equity using the CAPM calculation? Did you come up with the CAPM calculation for the expected cost of the debt or expected return? Sorry, expected return on the equity?
You got 0.08, I'm not sure.
Yeah, so why don't you give me the assumptions that you used for the expected return on the equity?
For the data we put.
No, just give me the whole equation.
Oh.
Start from the beginning.
It's, one second.
What did you use for the forward risk-free rate?
0.8%.
No, for the risk-free rate.
Okay, use 8%.
Used 8%. No, is that too high? Yeah. What did we say was the forward projection on the 10-year treasury by the end of next year? 3%. Okay. And then what was your forward-looking estimate on the beta?
1.09.
1.09, so 1.1. Okay, so you think that the beta for JP Morgan a year from now is going to be exactly the same as the reported beta that was reported in, I don't know what source we got the 1.1 from. So you think it's going to be exactly the same?
That was our assumption.
Your assumption is it's exactly the same?
Not so
Exactly
much.
the same. Because we read the research reports too. So if you use the exact calculation, that basically means that you just took the calculation from the current source and you just brought it over, and just to be easy, just said, okay, it's going to be exactly the same. It's totally impossible that the beta for next year is going to be exactly the same as it is right now, calculated from a source that was calculated in September.
Let's use 1.2.
Okay, if you use 1.2, I'll know that you thought about it. If you use 1.1, I know that you just used what was reported in the September report of S&P. Okay, because I read all that stuff too. So a lot of these guys memorize all of these numbers. They have photographic memories, so they totally know all of the numbers. They memorize the numbers. Seriously. Okay. So you got to come up. You got to be a little bit more creative. Okay. And then what was the expected return on the market that you used?
8%.
You used 8. Okay. Okay. And we already know what the risk-free rate is. Okay, so this is 6. So what's 1.2 times 6? And Kevin, was I going to sign something for you? You just hang out?
Yeah.
Okay, cool. And then what was so what is 1.2 times 6? 7.2, 7, 8, 9, 10, so this is basically 10.2 or basically 10%. That's your count. Now, what about the cost of the debt? How do we calculate the cost of the debt? We know it's the risk-free rate is what we start off with, plus some risk premiums. So rule of thumb, what would be the risk premium that you would tack onto the risk-free rate? Rule of thumb to get an approximate cost or expected return on the debt. what's the rating on this firm?
A minus.
Is it A minus? Okay. All right. So do you think you're gonna tack on 500 basis points on top of this thing? 500 basis points? So basically their cost of debt is 8%. Does that sound right? For eight, remember A, B. Is this a triple B company? Is this a triple B company?
That was an A minus.
Yeah, it is A minus. I'm asking, is it a triple B? No, it's not.
No.
So is there a lot of credit risk associated with this firm?
No.
No. Is it conservatively leveraged?
Yeah.
Yep. Okay, so do you think that, if it's conservatively leveraged, do you think that the risk premium is gonna be 500 basis points? Risk premiums that you tack on the risk-free rate for JP Morgan is gonna be 500%, so you're gonna get an 8% cost of debt. Doesn't this seem a little high for a company of $2 trillion that's conservatively leveraged, has lots of cash and is conservatively leveraged, and doesn't have a lot of debt outstanding? So does the 5% sound a little high? Yeah, if you can find any yield maturities on their 7 to 10-year debt, if you can go back, even if you can Google, yield maturity on JP Morgan debt of 7 to 10-year maturities, you're probably gonna come up with something. These firms have very low costs of capital, extremely low costs of capital. Can they issue debt at 3%? No. Are they the federal government? No. So they cannot issue anything less than 3%. So 4%? 4%? Maybe. 100 basis points on top of the 10-year treasury? 4%? What about 5%? What about 6%?
Maybe a little high.
Maybe a little high. What about 7%? Probably too high. What about 8%?
Way too high.
Probably too high. So process of elimination. So it's probably between 6 and 4. What's the midpoint?
5.
So if you know what it is, and you can narrow in and know what it is. So it's a deductive reasoning, and that's going to be good enough. Okay. So when I ask you how did you come up with your cost of your debt, well, we ran it. We know they can't issue debt below 3%, so it's got to be at least 4. We know it's not going to be 500 basis points risk premium on the risk-free rate, because that gets us to an 8. Or 7%, we know they can issue the debt significantly less than that. So we came up with a cost of debt range between 5 and 6, and we figured, and we actually saw that some of their bonds that are currently outstanding and when they were issued and are currently yielding around 5%. So we're going to use 5% as the cost of the debt. Was I able to explain that away? Was I able to explain it away? Instead of saying, I don't know. Or we just came up with a number, or we pulled it out of the report that you gave us and we used 5% because that's what we got from the report. So you gotta be able to explain it. Okay. So now we got 5%, we got 10%. Seems like a pretty big range, but that's okay. So now we need to get the weights. Where do you get the weights? Can you calculate the weights from the annual report using the book value?
Yeah.
Yeah. Can I look up Emergent and Value Line and S&P and Morningstar and maybe on the company's website? Do you think that they would be able to provide me what the capital structure is? How they're financing their assets? How much is debt and how much is equity? And don't you know off the top of your head kind of what it is? Right? Is it 70-30?
Yep.
Is it 70-30?
Yes.
It is? So 70% debt and 30% equity?
For JP?
Yes.
No.
No, it's not. So it's gotta be either 60-40 or 50-50. Do you think it's 50-50?
No, it's 42.58.
So what is it?
42. No, if the debt is 42%.
Yeah.
And the
So we
equity
got
is 58.
42% and 58 is the equity?
Yeah.
Is that possible?
Right now, yeah.
Yep. Is the have the banks been deleveraging over the last 9 years? Yeah, so the amount of debt has been falling, okay? Are their stock prices high? So their equity weights are higher. So they've deleveraged their debt. Their stock prices have gone up. So theoretically, they should have a higher weighting to the equity as opposed to the debt, although this is counterintuitive, right? Probably their optimal and target capital structure is probably 60% debt, 40% equity. That's probably their target, but this is their actual. So the question for you is, do you use the target or do you use the actual? And if you use the actual, is the weighted average cost of capital going to be higher or lower than the target? Let's think about this. Under this weighting scenario, compared to this weighting scenario, which one is going to give you the highest weighted average cost of capital? This one or this one? Which one's going to give you the highest weighted average cost of capital? WACC A or WACC B? Which one's going to give you the highest cost of capital? WACC A or WACC B? A. Why?
Because there's more equity.
Higher weight of the equity, and is the cost of the equity higher or lower than the debt? Higher. If we use this scenario, are we more or less conservative? We're going to be more conservative. Do you want to be more conservative or less conservative? Maybe more. I mean, it's really up to you to decide how you want to do the valuation. Okay? And again, at the end of the day, the numbers aren't going to be that much difference because you're going to capture the differences in the scenario, in the sensitivities, in the sensitivity ranges. Okay? So what is our, do you want to use this or this?
A.
You want to use A? Okay, so we know that 42% is coming from the debt, and we know that's 5%. And we know that 58% is coming from the equity, and we know that's 10%. So give me the weighted shares for this. So what's 0.42 times 5?
2.1.
What is it?
2.1.
Okay, and what's 0.58 times 10?
5.8.
Okay, and then you got 9 and 5, so there's your 7. Okay. So this gives you what, 8%? You get a 10%. You get a 10% cap out. And what do we get? Percent, 9%, and 10%. Return on the market, or the WACC. This could be the expected return on the market also. And this is going to be the capital asset pricing model. So basically, through the calculations, you set the sensitivities which become your discount rates. So I'm going to ask you, where'd you get your discount rates? Well, we calculated the WACC rate at 8%. We also know that the expected rate of return on the market is between 8 and 10%. We also did the calculation on the CAPM. We came up with a 10% discount rate. So then we just plugged the 9 in between to create the sensitivities. Basically 1 percentage point between the two, between them to create the ranges. So you now have validation in your approach to determining the discount rates.
Depending on what numbers you use, are you gonna have different percentages, like?
Well, if you go 7, 6, 5, you know, you're gonna get really high valuations.
Okay.
If you get 11, 12, 13, you're gonna get really low valuations.
I guess my question is, like, do they have to be one apart, like, it's,
I would do it that way. Because then the ranges get to be too high and too low. And then the 2 percentage point spread between them is really too much. Okay, but you can see it fits really well, right? Because we know the expected rate of return on the market and the WACC justifies the 8. We know that the expected return on the market is between 8 and 10, so it justifies the 9. And we calculated the CAPM at 10%, that validates the 10. So you have basically an approach and a methodology behind determination of the discount rates. Nobody's gonna mess with you if you can articulate that, if they ask you. How did you come up with your discount rates? We calculated the WAC, we knew the expected return on the market was between 8 and 10, and we calculated the 10% using the CAPM. They're not gonna argue with you. They may ask you what your assumptions are on it, but you already have that in the table, right? You have the CAPM table and you got the WAC table to, again, justify your numbers. So you're doing validation, nobody's gonna question you.
Where should I put the cap and the WAC tables? Like on
They're on the, I believe CAPM is on perpetuity and Gordon growth.
So repeat it now.
Yeah,
Okay.
and then I believe in DCF model, I put the WAC there, so that I know you know how to calculate WAC. But what I'll do is I will be calculating, I'll have a calculator, and I'll be checking your CAPM and your WAC calculations for validations. Okay, so that's what these guys are gonna do too, is they're gonna look at your presentations, and they're gonna start doing the numbers. They'll start checking the numbers to make sure they're correct. And you don't want them to have errors in the calculations, because then they'll question everything, and they'll say pretty much, oh, next group, you guys go back, fix it, and then come back and do the presentation, which you might not have a chance to do that again. Okay, any other specific questions? Did that answer your question on the WAC?
Oh, yeah, definitely.
Okay,
Thank
cool.
you.
Were you able to find any JP Morgan bonds? Is anybody able to find any yield maturities on JP Morgan bonds? Google, or maybe going up to S&P or Moody's or Fitch. Maybe you can do a search, on rated bonds by company, by ticker, just to have a little bit more validation, verification, not an interpolation, of the cost of the debt, but actual comps, where you can reference and say, oh yeah, they issued a 10-year bond a year ago, with a yield maturity of 5.5%. But we're expecting, rates to stay level, and maybe you think rates are gonna go up, more, and they issued the bonds at 4.5% or 5% a year ago, or 2 years ago, and you think interest rates are gonna be 100 basis points higher from then to next year, and they issued it at 4.5, and we're forecasting 100% increase in the risk-free rate. So if they issued those bonds again today, they'd have to issue them at 5.5, because the risk-free rate is higher. If you can articulate something like that, that would be amazing. Because you did the research and you can totally argue away how you came up with the cost of the debt or the expected return. Okay, any other questions on the individual scenarios? Yeah.
So for the peer group.
Yeah, do you want to do the ratio analysis?
Yeah, but I would just have a question, because
Okay.
there's like the profitability ratios, the leverage ratios, equity ratios.
Yeah.
Do you want us to do the peer group for every single one of those, or just
Yeah.
for the
Yeah,
weighted
you gotta
ROEs?
do a weighted average
Not for just the ROEs, it's for every single thing.
for everyone.
And
Yeah.
then
That's why you gotta program it.
That's using the assets and just multiply them by.
Yeah, the assets give you the weights.
And then you multiply those weights by basically everything.
Yeah,
And then, okay.
yeah, so you already have the top 5 banks, right, with the assets.
Yeah.
So you already got that table. And if that table, you put that into Excel, you replicate it in
Yeah.
Excel, get
That's
the
how you do
weights,
it. That's how you do it.
right? And then what you could do is you could set it up, where you just plug in the numbers, right, and it calculates the weight.
Yeah, that's what I'm doing
And
now.
if you lock the cells on those weights, in Excel, if you lock the cells on the weights, you can just copy that row, bring it over, and then put in the ROA. Copy it over, put in the profitability
Yeah.
ratio. You could do it like that, or you could just copy that table, replicate it, turn it from ROE to ROA, and boom, you got the peer group.
And then we need to do it for net profit income
Yep.
and all that.
Yep, because the problem is that IBIZ and S&P in their industry reports do not provide peer group.
Okay.
Okay, and the peer group's the most important calculation. they can blow away the industry ratios. It's really how are they performing compared to the peers. So you gotta be able to take the average for those peers, or if you have in, what was it, S&P or Value Line that had the year-to-date averages, the most current financial ratio for ROE. If you have that, then you don't have to do the average for the last 4 quarters. If that source has given you the average for the last 4 quarters, year-to-date, then just use that.
Okay.
Okay, if they give it to you. If you don't have it and you have to go back, you're gonna have to go back and calculate the last 4 quarter average.
Okay.
And then use that to do the weighted averages for the peer groups. Okay, is everybody clear on the ratio analysis, or do I need to walk through that again? I'm not convinced.
And then just for the financial conditions, you're basically comparing what they got off the peer group average as the.
Yeah, and again, what you wanna do is compare, let's say ROE for JPM. Well, the first thing I'm gonna do is I'm gonna look at, did they blow away Wells Fargo? Was it greater than or equal to or less than Wells Fargo against the direct peer? And then I'm gonna look at the peer group. And that's the one I really care about. So if ROE is above the peer group, then I'm gonna give it a good. If it's significantly higher than the peer group, I'm gonna give it an excellent. If it's slightly below the peer group, I'm probably gonna give it a average. So if it's equal to the peer group or close to the industry, and it should be above the industry. I mean, the industry is compared to like 2,000 companies. But if it's at the peer group, or slightly below the peer group, I give it a above average. If it's below the peer group and close to the industry, I give it an average. If it is below the industry, give it a below average. And if it's significantly below the industry, which it's not gonna be, I would give it a 4. I've never seen a 4. The only time I've seen below averages is people make calculation mistakes. They either make calculation mistakes or they're using financial ratios from multiple sources. So they're not calculated in the same way. So I've seen it there. I've seen average before. I've definitely seen average, above average, definitely good, and I've seen some excellence too. So if they're getting good to excellent, then I would give it a overall financial condition or position of good. If they're getting above average, good and excellent, I'd probably, if they're getting these 3 together, I would still probably give it a good overall financial condition. They're probably not gonna get these combinations with these. It's probably not gonna happen. And if they're getting here and here, I would probably give them an above average here. But again, they're probably not gonna get that. You're probably using multiple sources and your calculations are incorrect. Because these are the top 5 banks, right? The most competitive banks in the world. And they really manage their financial ratios because they want to get the highest ratings to push down their debt, and they want to maximize the stock price. And if they can push down their cost of capital, they can borrow cheaply and grow the firm in opportunistic periods like next year when Dodd-Frank is probably repealed or watered down. Okay, any other questions on that? Do we want to do an example on the financial ratios? You want to do one? Yep, okay. So let's do that. Is this all review?
Hold
Everybody know Kevin? See, I'm Kevin. Kevin went through my first class. He still has the mental scars and physical scars from the first class. Okay, so give me the assets for the top 5 banks from that table. And you may want to update that table in there that gives the assets for the bank. How big are these banks? And give me their bank assets, okay, not their investment banking assets. So can you give me the assets for JP Morgan, Wells Fargo, B of A, Citi, and Goldman Sachs? And tell me what year were these assets, and what's the most current? Like 2016? And can you give them to me in trillions?
2.5.
Okay. What's Wells Fargo?
2.2.
2.2. B of A?
2.
Citi?
1.7.
And GS is what, 0.9 or something?
0.
That's okay.
No, those are out of order.
And I would actually rank them too.
Wells Fargo is actually 1 point.
What is it?
My numbers are different.
What?
My numbers are different.
Yeah, so
Yeah, are you using 2015, 16? Are you using total bank assets? You just gotta be consistent, right from the source, so you should get it.
So if they're all from the same source, it doesn't.
It doesn't matter,
Okay.
because the relative ranking and the weights are gonna be the
C
same.
of A is higher than Wells Fargo and the one I saw.
Okay, well, let's just use this as an example, okay? So I'm just gonna say 2 for Wells Fargo, just to keep the math. So this is not correct, but unless you wanna give me the correct ones, then I'll redo it. But I was just doing this for illustrative purposes.
Okay.
You wanna give me the correct numbers, or, okay, do you have them?
Yeah, I have them.
Okay, give them to me then,
2.5. B of A is 2.2.
okay,
Wells is 1.9.
okay,
Citi is 1.8.
okay.
And
JP?
Yeah.
Yeah, and Goldman's like 0.9,
yeah.
okay. So add these up and give me the sum total. And these are all in trillions. Do not give them to me in billions or millions, just give them to me in trillions. It's cleaner.
9.3.
Okay, and what's 9.3 divided by 2.5?
0.27.
And what is 1.9 divided by 9.3?
Point. 0.0.
What?
Oh, 0.20, sorry.
0, and then what is 2.2 divided by 9.3?
0.24.
Okay, and what is 1.8 divided by 9.3?
0.19.
And what is 0.9 divided by 9.3?
0.10.
Or 0.1?
It's 0.096. So
Okay, put some 0.1. Can you add this up and make sure it adds to 100%? 1. You may need to just round up or something just to adjust it, but it should add to 100. It does? Okay. So can you give me the ROE for these banks? Either from one source year to date, I'll even take 2015, or an average of the last 4 quarters.
JP's 9.5.
What is it?
JP's 9.5.
Okay,
Wells Fargo is 11.9.
okay.
Okay.
Yeah. 6.2.
And what'd you get for Citi?
6.4.
Okay, and what do you get for Goldman?
7.2.
This is interesting here, because I would think Goldman, since it's levered, investment banking, institutional client services would be higher than this. So this might be right. Are you giving me
That's
here?
coming off Morningstar.
Oh, these are all Morningstar for 2016
Mhm.
year to date.
Mhm.
Okay, when was it updated? Because wasn't there some bad press over the last couple of months by Wells? Probably 2, but I'm just checking the numbers, right? Cause just based on what I would know,
As of, this is as of.
these two would be low.
As of yesterday.
Yeah.
This one makes sense, this one doesn't make sense.
All these numbers were as of yesterday.
Okay, got it. Okay, so we got validation, excellent. Okay, now we got the weights, and we got the ROE. So give me what is 9.5 times 0.27?
2.6.
2.6, and what is 11.9 times 0.2?
2.4.
And what is 6.2 times 0.24?
1.5.
1.5.
1.
Thank you. And then what is 6.4 times 0.19?
1.2.
And then what, and this is what, 7.2?
0.7.
0.7.
0.7, okay. So add these up. What is it?
8.4.
So there's your peer group ROE. Now you just you wanna do ROA,
No.
so you can check it, making sure that you're doing it right. So the weights don't change. Okay, go ahead.
GP is 1.0.
What is it?
1.0.
Okay, that seems right.
Wells Fargo is 1.1.
Okay, that seems right.
BFA, 0.7.
That sounds right.
City's 0.7 as well. And Goldman's 0.6.
So what's 1 times 0.27?
0.27.
0.3, something like that. 1.1 times 0.2,
Yeah.
Wait, say that again?
1.1 times 0.2. Again, this is your weighting factor.
0.22?
Okay, and then 0.7 times 0.24.
0.16.
What is it?
0.16.
And then 0.19 times 0.7. Then 0.1 times, so this is what, 0.6? All right. That one.
Yeah.
So what's 0.3 plus 0.22 plus, plus 0.16 plus 0.13 plus 0.06? What is it? 0.85, 0.9. This is gonna be your ROA. For the peer group. Okay? So then you do that for the other ratios. And if you got this programmed in there, you just change this out, right? It's the only thing that changes. Copy, paste, and build. Copy, paste, build. So you should be able to move through it pretty quickly. The challenge is gonna be finding the industry ratios. You're gonna have to go to S&P and IBIZ to get the industry ratios. And if you can't find the industry ratios for the ratios that you're using for some reason, just freaking make it up. Just make it reasonable. Just guess. Just make sure it's reasonable. And it's probably gonna be below the peer group, and it's gonna be below the 2 banks, right? So you can just fit it, right? And then move on. Nobody's gonna question, nobody's gonna really look at the industry ratios. That's all we wanna know is what your code is, and what your overall assessment's gonna be. Okay? What else? We did assumptions, we did valuations, we did target firm, we did scenario analysis, we did trades and recommendations, talked about the videos. What else are we missing? Wells Fargo? Should we do Wells Fargo? Should we do Wells Fargo? Okay. Let's, why don't you take that camera and bring it over there? I'll do Wells Fargo over here. Make sure I have the whole, if you guys want to stay here, you can stay here with that. You can
Everything's in the frame. Do you want me to zoom in?
Okay. Just, yeah, zoom in if you can so that you can see what's on the board.
Okay.
But if if it's capturing this whole thing, just keep.
It is. It's the whole board's on there.
So can you